Welcome everyone to Finwell Daily Brief, episode 57. It's June 10th, 2025, and we're diving into today's market close and the wider Indian financial landscape.
Great to be here. We've got a financial briefing packed with insights today, covering everything from household savings right through to RBI policy and even some pretty sharp investor warnings.
Exactly. So think of this as your essential download. We'll unpack the key numbers and narratives from this material, figure out what matters most, and what it might mean for you. Ready to jump in?
Absolutely. Let's kick things off with a financial fact highlighted right at the start, something positive, actually.
Oh, good. Always nice to start with good news. What is it?
It's about India's net household financial savings. The briefing notes they've actually rebounded.
Okay, rebounded. How much and why is that significant?
Well, they've bounced back to 5.1% of gross national disposable income for the financial year 24. And the reason it's a big deal is because this is a recovery from a multi-year low.
Okay, so reversing a worrying trend then.
Precisely. And economists quoted in the material, they're actually expecting this improvement to continue. They link it to a more positive economic outlook overall, and importantly, moderating inflation.
Right. When people feel a bit more secure about the economy and prices aren't rising quite so fast, they tend to save more. Makes sense.
Exactly. It signals maybe a bit more confidence and provides, a stronger base for the financial system. It's definitely a green shoot mentioned right up front.
Okay, a positive start.
Right.
But then the briefing shifts gears to the Reserve Bank of India, the RBI. Sounds like they've been pretty active.
Oh, definitely. The briefing details some quite aggressive moves, actually. We're talking a 50 basis points repo rate cut.
50 basis points, okay.
And on top of that, 100 basis points cut in the cash reserve ratio, the CRR.
Wow, that's significant easing. What's the stated goal behind these cuts?
The intention is pretty clear. Inject more liquidity into the system, make borrowing cheaper, and hopefully stimulate consumption and investment. They're particularly trying to encourage small and medium enterprises, SMEs, to invest.
Right, trying to get money flowing, especially to smaller businesses. Sounds like a classic stimulus playbook. But does the briefing suggest it's working as planned?
Well, that's where the nuance comes in, and it's really crucial. The briefing raises a big question. Is the stimulus actually translating into real economic activity?
Meaning,
Analysts cited in the material are warning that banks are, still being quite cautious. They seem hesitant to really open the lending taps, especially to segments they perceive as riskier, like some SMEs.
Okay, so the RBI cuts rates, but banks aren't rushing to lend more.
Exactly. And maybe even more importantly, the demand for private investment hasn't really surged yet, despite these lower borrowing costs.
I see. So the RBI is pushing, but maybe the pull from borrowers and the willingness of lenders isn't quite there yet. It's like that old saying, you can lead a horse to water.
Precisely. That disconnect between policy intent and on-the-ground reality seems to be a key theme here.
Interesting. Okay, speaking of market signals, what's the bond market telling us according to this briefing? Anything jump out?
Yeah, the bond market picture is also quite revealing. The material notes that Indian government bonds had rebounded recently after a bit of a drop.
Okay, some stability there.
But then today, something else happened. The benchmark 10-year bond yield, it rose sharply.
Sharply? How sharp are we talking, and what does a move like that usually signal?
Well, it jumped to 6.69% today, up from 6.28% just yesterday. That's a pretty significant move for government bonds in one day.
Definitely catches the eye. What's the interpretation?
The briefing suggests this is a key signal from traders. They seem to be repositioning, basically betting that there won't be much more easing coming from the RBI anytime soon.
So the market is saying, okay, those big cuts were nice, but maybe that's it for a while?
That seems to be the message. They're anticipating a period of consolidation where yields might stabilize or even drift a bit higher, rather than expecting further aggressive cuts.
Fascinating. The central bank acts, but the bond market is already looking ahead and perhaps showing some skepticism. Okay, so with that backdrop, how did the equity markets actually close today, Juneteenth?
Well, reflecting that perhaps the main index, the Nifty 50, was essentially flat. Finished up just over a single point.
So very quiet on the large cap front. What about the broader market?
Marginally positive, but still pretty subdued. The Nifty Midcap 150 edged up just 0.03%. The Nifty Small Cap 250 was up 0.17%. And the Nifty Total Market Index also saw a small gain, basically a consolidation day across the board.
Okay, aligns with that bond market signal and maybe the wait and see on credit growth. What about the currency, the rupee?
The rupee held fairly steady today. It was trading around 85.59 per US dollar, showing just marginal strength. The briefing partly attributes this stability to RBI interventions, helping to manage volatility.
Got it. Now let's circle back to those RBI rate cuts. Even with the banks being cautious, the briefing does highlight specific areas that could really benefit if that credit does start flowing more freely, right?
Yes, absolutely. If the transmission mechanism improves, the potential impact is highlighted, particularly for SME and retail lending.
And why those two segments specifically?
It's down to how their loans are structured. According to the material, about 80%, a huge chunk of retail and SME loans, are directly linked to the repo rate.
Ah, so when the repo rate falls, their borrowing costs should theoretically drop pretty directly.
Exactly. The connection is much tighter than for, say, large corporate loans sometimes. And the briefing even puts a number on the potential impact.
Oh, what kind of number?
It estimates that this easing could unlock somewhere between 500 to 600 billion rupees for new investment and consumption within these sectors.
Wow, 500 billion rupees. That's a serious amount of potential fuel for the economy if it gets deployed.
It really is. Lowering borrowing costs for small businesses and consumers could be very powerful. And it's a big stressed in the briefing.
Let me guess the cautious banks again.
You got it. The material constantly circles back to that caveat. Banks are still wary, especially about perceived risk. So the potential is there, the mechanism exists, but the actual credit uptake, that remains the key uncertainty.
And are other sectors mentioned as potential beneficiaries, assuming things loosen up?
Yes, infrastructure and overall consumption are also noted as sectors that could benefit from lower rates and potentially improved credit flow. But again, it all hinges on that credit actually picking up.
Understood. Potential versus reality. Now, this briefing also looks beyond India's borders. What's happening internationally that investors here are apparently watching closely?
Right. The global context is always important. The briefing notes that Indian equities kind of held steady today, partly because investors globally are looking ahead to some key events in the U.S. later this week.
What kind of events?
Specifically, U.S. inflation data, the CPI numbers, and then commentary from the U.S. Federal Reserve. Those are the big ones on the radar.
And why does U.S. inflation and what the Fed says matter so much for us here in India?
Well, they're major drivers of global market sentiment and, crucially, international capital flows. Decisions made in the U.S. about interest rates based on their inflation outlook can cause money to flow into or out of emerging markets like India.
So potentially causing volatility here.
Definitely. The briefing points out that surprises or strong signals from the U.S. data or the Fed could certainly ripple through global markets and impact domestic markets here in the near term. You can't just look inwards.
Makes perfect sense. Okay, now the briefing takes a very specific turn, highlighting a particular investment. Or maybe a warning about an investment.
Yes, and this section is, I think, incredibly valuable, especially for retail investors. It puts a spotlight on a specific SME IPO that's an initial public offering for a small or medium enterprise. The company is Sesharom Ltd.
Sesharom Ltd. SME IPO. What are the basic details mentioned?
Okay, so it's an SME IPO looking to raise about 41.2 crore rupees. The price band is set between 95 and 100 rupees per share, and the briefing notes it's closing very soon, June 12th.
Got it. Standard IPO info. But I sense there's more. The briefing flags some issues.
It flags several significant red flags, as it calls them. This is where it gets really interesting from a risk perspective.
Okay, let's break them down. What's the first red flag?
First up, it's described as a low-margin business. The analysis shows its profitability, specifically its EBITDA margins, are lagging behind its listed competitors in the fragrance and flavors industry.
Lower margins mean less buffer if things go wrong.
Exactly. Less room for error, potentially weaker financial health compared to peers. That's flag number one.
Okay, what's next?
Second, working capital risk. This sounds technical, but it's critical. The briefing points to high levels of receivables and inventory days.
Can you unpack that bit? What does that mean practically?
Sure. High receivables mean the company sells stuff but takes a long time to actually collect the cash from its customers. High inventory days mean it's holding onto its stock for a long time before selling it.
And both of those tie up cash.
Precisely. Cash gets locked up in unpaid bills and unsold goods. Even if you're making sales on paper, if the cash isn't coming in quickly, it can cause a real squeeze. It's a major operational risk.
Right, a cash flow crunch waiting to happen. What's the third flag?
Customer concentration. This is a big one. The material states that over 60% of Sesharom's revenue comes from just its top 5 clients.
60% from only 5 customers. Wow.
That sounds risky.
Extremely.
Yeah.
Think about it. If even one or two of those major clients decide to reduce orders or switch suppliers, it could hammer the company's revenue almost overnight. Huge dependency risk there.
Definitely. Okay, any more flags?
Yes, one more significant one. Lack of anchor investors.
Anchor investors, those are the big institutions that commit up front, right? Why is their absence a concern?
Exactly. Anchor investors are typically large mutual funds, insurance companies, sophisticated players who do deep due diligence. Their participation is often seen as a stamp of approval, a signal of quality. The briefing highlights that despite marketing efforts, no anchor investors came into this IPO. That absence is seen as a notable negative signal.
Okay, so let's recap the red flags. Low profitability compared to peers, potential cash flow issues from working capital, heavy reliance on just a few customers, and no backing from major institutional investors. That's quite a list.
It really is. So what's the final verdict, the critical take from the briefing on this Sacharome IPO?
The conclusion is pretty blunt. It describes Sacharome as a high-risk, low-moat business, meaning it doesn't have strong competitive advantages operating in a cyclical sector.
And the advice for investors?
Very clear advice. Retail investors should be extremely cautious and, the briefing suggests, probably avoid speculative entries into this IPO. It's presented as a case study in the kind of high-risk proposition you can find in the SME IPO space, requiring serious scrutiny.
That's a very pointed and valuable warning.
Yeah.
Okay, stepping back from that specific case, how does the briefing summarize the overall market outlook for investors right now? What are the key takeaways?
Synthesizing the various points, the material suggests the markets have kind of hit pause after the recent run-up, that jump in bond yields we discussed. That's seen as the market signaling skepticism about more RBI rate cuts soon.
Right.
And critically, the RBI's easing, while significant on paper, hasn't really lit a fire under broad credit growth or private investment yet. There's still that disconnect.
So, given that somewhat cautious assessment, what's the investment advice coming out of this briefing?
The advice leans strongly towards being cautious and focusing on quality. Stay defensive, maybe. The briefing specifically recommends avoiding over-leveraged mid-cap stocks companies with too much debt can be very vulnerable if conditions tighten.
Okay.
And echoing the Sacharome example, be incredibly wary of speculative, high-risk IPOs, especially in the SME segment. It's about prudent selection, managing risk, not chasing everything that moves.
Quality over speculation, caution over leverage. Got it. Now, finally, before we wrap up, the briefing includes one more warning, something very practical, not about markets, but about security.
Yes, and this is so important for everyone, not just active traders. It's a reminder about the constant threat of phishing and impersonation.
Oh, the scammers trying to trick you online.
Exactly. The briefing highlights how they use fake emails, dodgy websites, maybe even text messages that look official, trying to fool you.
And what's their ultimate goal?
To steal your sensitive information, bank account details, login passwords for your investment accounts, maybe crypto wallet keys, or just gain access to your accounts directly.
Nasty stuff. Does the briefing list common tactics to watch out for?
It does. Key red flags include messages creating a sense of urgency, demanding you provide personal data right now, suspicious links or attachments never click blindly, and offers or warnings that just seem too good or too alarming to be true.
Because they usually are, right?
Almost always. If it feels off, it probably is.
So what's the core advice from the briefing on protecting yourself?
The absolute key is always verify. Before clicking, before replying, before giving any information, independently verify the sender or the request. Go to the official website of your bank or broker yourself. Don't use the links in the message. Use official contact numbers you already know are correct.
Be skeptical. Double-check everything through official channels.
Exactly. Apply that same critical thinking you use for investments to your emails and messages. Don't let urgency override caution.
That is absolutely vital advice in today's world. Okay, so we've journeyed through quite a bit today, based on this June 10th briefing, started with the uptick in household savings, navigated the RBI's rate cuts and the challenges in credit uptake, felt the bond market's signal, glanced at the flat equity markets, considered potential sector winners, looked at U.S. data cues, dissected that specific SME IPO warning, summarized the cautious outlook, and finished with that crucial phishing alert.
It really paints a picture, doesn't it? There are positive undercurrents like the savings data and supportive policy actions from the RBI. But then you have these real-world frictions, cautious banks, hesitant investment, external factors, and specific company risks demanding a very careful approach from investors. The overall tone feels quite measured, quite cautious, despite the rate cuts.
It certainly does. And maybe that caution brings us back to some fundamental wisdom. There's a quote mentioned in the briefing, attributed to Warren Buffett, that feels relevant. Do not save what is left after spending, but spend what is left after saving.
Pay yourself first. A timeless principle.
Indeed. So, as you digest all this information, the market pause, the bond yield signals, the specific risks, perhaps the final thought this briefing leaves us with is this. In such a complex environment, how do you, as an informed investor, truly distinguish the real signals from all the noise and find those genuine quality opportunities while navigating the risks?
That is the perennial challenge, isn't it?
It is. Now, if you found this discussion helpful, please do subscribe to FinWell Daily Brief wherever you get your podcasts.
And we always appreciate feedback or questions. You can connect with the team behind SOS FinWell on LinkedIn.
Thank you so much for tuning in.
Thank you.
Please remember, the information discussed today is based on the financial briefing dated June 10, 2025, and is intended for informational purposes only. It is not investment advice. Market data is sourced from SEBI-registered exchanges and regulatory filings as referenced in the briefing material. Always consult with a qualified, certified financial advisor before making any investment decision.